A market bubble happens when asset prices soar far above their true value, often driven by a mix of excitement, speculation, and a belief that the good times will never end. It's a phenomenon that can affect everything from stocks and real estate to cryptocurrencies and even collectibles. Picture a balloon being inflated more and more, stretched to its absolute limit, ready to pop at any moment. The bigger it gets, the more dramatic the eventual burst. When the bubble finally bursts, prices can collapse almost overnight, wiping out fortunes and leaving latecomers with heavy losses. The aftermath can be devastating, not just for individuals, but for entire economies. Bubbles are fueled by a potent mix of excitement, greed, and the ever-present fear of missing out. As more people jump in, the frenzy grows, and rational thinking often takes a backseat. The tricky part? It's almost impossible to know you're in a bubble until it's too late. Even seasoned investors and experts can get swept up in the hype, convincing themselves that this time, things are different. As prices rise, people justify them with stories of groundbreaking technology or revolutionary business models. They convince themselves that the old rules no longer apply, and that this time is different. This contagious optimism spreads quickly, drawing in more and more investors, inflating the bubble even further. The cycle feeds on itself, as rising prices attract new buyers, which pushes prices even higher. Spotting a bubble in real time is incredibly tough. Traditional metrics like price-to-earnings ratios or historical averages can seem irrelevant during periods of rapid innovation or market euphoria. Revolutionary technologies and new industries make it even harder to judge what's pure speculation and what's genuine value. The line between hype and reality gets blurred. That's why bubbles keep recurring throughout history, from the Dutch tulip mania in the 1600s to the dot-com crash and the 2008 housing collapse. Each time the story changes, but the pattern remains the same. In every case, a compelling narrative about limitless future growth lures in millions of hopeful investors, all eager to get in on the next big thing. The narrative itself becomes more powerful than any financial analysis, as people focus on stories and dreams rather than hard numbers. Investors start to believe that prices will keep rising simply because they always have, ignoring the risks and warning signs along the way. This psychological momentum is what makes bubbles so dangerous, and their collapse so painful. In the end, it's a powerful reminder that in markets, as in life, what goes up can, and often does, come crashing down. Today, the financial world is obsessed with artificial intelligence. AI excitement has sent stocks like Nvidia, Microsoft, and Google soaring. Some companies have added hundreds of billions to their value almost overnight. Investors are betting AI will transform every industry, fueling a massive investment wave. The technology is already delivering. Generative AI writes code, creates images, and powers new business models. But are stock prices running too far ahead of reality? Hype and FOMO can create a feedback loop. Rising prices attract more buyers, pushing prices even higher. This is classic bubble behavior. The worry, current valuations may be based more on hope than on profits. Are we seeing a true revolution or just another hype cycle? The answer isn't clear yet. The AI revolution is driving a global data center construction frenzy. These massive, high-security buildings house the servers that power AI. Tech giants like Microsoft, Amazon, and Google are pouring billions into new data centers, betting on explosive AI demand. But building these facilities is slow and complex. Many projects are still just plans. The gap between announcements and reality is huge. Investors seem to be pricing in the success of every ambitious project. If AI demand grows slower than expected, companies could be left with costly, underused assets. The data center boom is a bold bet, but also a risky one. It's a physical sign of commitment, but also a potential bubble warning. The stakes are enormous. The promise of AI is huge, but so are the risks. The technology is still evolving. AI models can make mistakes and reflect biases. For critical uses like medicine or finance, reliability is essential. Running AI is expensive. Training and operating models costs millions in computing power and energy. If AI tools are too costly, many businesses and consumers may not adopt them. Companies must find ways to make AI profitable despite high costs. If costs stay high, AI could remain a niche tool for only the biggest players. The market is betting on mass adoption, but that's not guaranteed. If revenue doesn't materialize, companies could be left with massive unprofitable investments. That's the classic setup for a bubble to burst. If the AI market stumbles, tech giants like Microsoft, Google, and Amazon have a big advantage. They're diversified, with huge profits from software, search, e-commerce, and cloud services. This financial cushion lets them weather AI setbacks without existential risk. They can keep funding AI, waiting for the technology and market to mature. Unlike startups, they can integrate AI into products billions already use, giving them a built-in customer base. If standalone AI demand weakens, they can pivot, using AI to boost their own efficiency or acquiring struggling startups. A downturn could even strengthen their dominance, as they consolidate the industry. Their size and diversification act as a shock absorber. For big tech, AI is a long-term play, not a make-or-break gamble. The AI boom draws constant comparisons to the dot-com bubble of the late 1990s. Back then, internet stocks soared on hype, often without real revenue or business plans. The narrative, invest now or miss out on the future. Today, AI stocks, especially chipmakers, are seeing similar mania. But there's a key difference. Today's leaders are profitable giants, not cash-burning startups. Microsoft, Google, and Nvidia have real products, massive revenues, and strong balance sheets. They're investing from a position of strength, not desperation. This makes the current situation more stable than the dot-com era. While valuations may be high, the companies themselves are solid. That's a crucial distinction often missed in bubble talk. Today's AI boom is fundamentally different from the dot-com era in several important ways, reshaping not just technology, but the entire business landscape. While the late 1990s were defined by a rush to build websites and attract online traffic, today's AI revolution is being driven by a race for computing power and infrastructure on a global scale. The dot-com bubble was all about software, digital platforms, and speculative website launches. In contrast, the AI boom is centered on hardware, specifically the powerful chips and sprawling data centers that make advanced machine learning possible. The supply of these advanced AI chips is limited, with Nvidia holding a dominant position in the market. This creates a bottleneck, as companies scramble to secure enough hardware to fuel their AI ambitions. To keep up, companies are pouring billions of dollars into hardware and infrastructure, making massive upfront investments just to stay competitive in this rapidly evolving field. Unlike the speculative spending of the dot-com era, these investments are essential. Without them, companies risk falling behind in the AI race. The result is a massive, steady revenue stream for chipmakers and infrastructure providers who are now at the heart of the AI economy. Another key difference is the customer base. Instead of millions of fickle consumers, today's AI boom is powered by a handful of giant corporations with deep pockets and long-term strategies. Tech giants like Microsoft, Google, Meta, and Amazon are leading the charge, making strategic multi-year investments that are unlikely to disappear overnight. Their spending is more stable and predictable, providing a solid foundation for the industry's growth and reducing the risk of sudden collapse. This corporate-driven demand suggests that the current cycle could be more sustained and less prone to the wild swings of past tech booms. Even if public excitement about AI cools, the need for infrastructure and ongoing investment may continue for years, supporting a robust ecosystem. The AI race is shaping up to be a multi-year, high-stakes competition, with companies and countries vying for leadership in a technology that could define the next era. This is more than just hype. It's a strategic arms race, with real investments, real infrastructure, and real consequences for the future of technology and business. So, what's next? The future of AI is uncertain, and it's too soon to call this a bubble or a smart bet. The next 18 to 24 months will reveal whether massive AI investments lead to real, profitable applications. The big question, will a killer app emerge, making AI indispensable for businesses and consumers? If AI investments don't pay off or costs stay high, investor sentiment could shift fast. Watch for signs: slowing data center construction, disappointing earnings, or stalled adoption. For now, the market is balanced between optimism and risk. There's a path to decades of growth and a path to painful correction. The key is to focus on real adoption, revenue, and profitability, not just hype. Should you fear an imminent AI crash? Probably not. While headlines may stoke anxiety and social media buzzes with warnings, the reality is more nuanced than a simple yes or no. The world of artificial intelligence is evolving rapidly, and with that comes both excitement and uncertainty. While bubble talk is everywhere, the current boom lacks the hallmarks of a classic collapse. Unlike previous speculative frenzies, today's AI surge is built on real-world applications, robust demand, and tangible results that are already reshaping industries. Today's leaders are financially sound, with diverse revenue streams and long-term strategies. Many of these companies have weathered past storms and learned from history, making them more resilient than the fragile startups of the past. This isn't the dot-com era of flimsy startups and pure speculation. Back then, many companies had little more than a website and a dream. Now, AI firms are delivering real value, with products and services that are already integrated into our daily lives. Still, some valuations are stretched, and a correction, where prices drop 20% or more, is possible, even healthy. Markets often get ahead of themselves, and a pullback can help restore balance and weed out weaker players. A correction would shake out excess, not destroy the sector. It's a natural part of any innovation cycle, allowing the strongest companies to emerge even stronger and more focused. Revolutionary technologies always attract hype and investment that outpaces reality. The excitement can lead to overblown expectations, but it also fuels the breakthroughs that drive progress. There will be setbacks, and not every bet will pay off. Some projects will fail and some companies will disappear, but that's the price of innovation and experimentation. But AI is a real, transformative force. Its impact is already visible in healthcare, finance, manufacturing, and beyond, changing the way we live and work. The current fervor may be excessive, but the revolution is real. The potential for growth and innovation is enormous, and we're only at the beginning of what's possible. The best approach: stay cautious, but don't lose sight of the long-term potential. By keeping perspective and focusing on fundamentals, you can navigate the hype and seize the real opportunities that AI offers.